So glad you're with us on Retire Well. Brad Johansen with Kevin Bucher, co-founder, Citizen Advisory Group. You and me hanging out. Looking forward to it, man.
Yep. Great show planned for today.
And it is, because I think we can set this up with kind of where we've been with this administration, can't we? That it feels like every 6 minutes we got something else going on, and there are changes. So we want to kind of take you through some of the financial changes that you may or may not know about and how we take advantage of some of this. Let's start with planning for minors, Kevin, if we can. What changed in the space now for parents that they need to know about as we start planning for this?
Yeah, I'm really excited about this part of it because it's not just parents, right? I'm a grandparent, so grandparent of 5.
As am I.
So I think it's really exciting time, and as far as some things that are available for us to do to help set up our kids and grandkids for success. So primarily we're going to look at a couple things: changes to 529 plans, as well as the new 530A accounts, otherwise known as the Trump accounts.
All right, let's start with 529s then, because people are familiar with this.
Yeah, so the big thing there, well, let me just give a little background of the 529 first. You know, they're educational accounts, so they're intended to be used for educational purposes. So there is a little bit of a state tax deduction that you may qualify for putting money into those accounts. But the big sweet spot there is you can invest these funds and withdraw them later for qualified educational expenses, and there'll be tax-free withdrawals.
Beautiful. Yeah, they worked for a lot of people.
Yeah, so the things that have changed recently, a couple major changes. Number one, they have expanded the uses of these qualified educational expenses. So we can now use them for some private school education, for K through 12 private school education. We can also use them for trade and vocational schools. And we can also use it to maybe pay back some student loans that might have been accrued. Now, there's limits on all of this, but they've expanded the use. And then the big thing is they've added the ability to convert these dollars over to some Roth IRAs later on in life.
Huge.
Yes.
To the point of, is it a $35,000 limit?
Yeah, so there's a certain time frame, so you have to have that account opened for a certain number of years, but instead of those funds just being left there to die, you can now can move those over into the Roth IRA with a maximum limit of $35,000. There's certainly logistics on how you have to move those dollars into the Roth IRA, because you have to do it based on contributions, so you can only do $7,000-ish per year based on today's rules. But yeah, those funds are no longer left to die in those educational accounts if they weren't used for educational purposes. We can now establish a Roth IRA and move those over so that beneficiary, that child, can have a Roth IRA established at an early age and have years and years of tax-free compounding growth.
It's a lot, right? And you're trying to figure this out yourself, which is why I'm going to put the number on the screen as we continue to talk. How do I keep up with this? Wouldn't you want to have experts who are up to date on all of the financial changes that you need to know about without having to memorize all of this stuff? 866-630-1675. Before we go out of the 529, well, this kind of takes us into that. You mentioned the account, but you mentioned it as a Trump account, and people are going, what? I haven't heard of Trump account. Take me into this.
Yeah, so it's a newer thing, right? So it's new legislation, and certain parts of it are still being worked out. And I think a lot of the hubbub has been about the fact that there's a contribution that the government is going to be making on behalf of many children. Now, there are certain criteria that have to be met. So, for example, it's for newborns that were born in 2025 through 2028. They actually are going to get a $1,000 contribution through a pilot program into this account on their behalf by the federal government. So I think a no-brainer decision is if you have a child that was born in 2025, or you're going to have a child born from now until 2028, you're going to get some free money by establishing this account. So that part of it is a no-brainer.
This is available now?
So it's you file for these accounts by filing Form 4547. So if you catch that, was strategically named that form there, 4547.
There you go.
And you can file that with your tax return, or you can go online and establish the account. Now, the accounts really aren't ready to be rolled out until after July 4th. So again, July 4th, strategic date there. So things are not quite ready to roll out yet, but you can get the account established. The accounts are open through the U.S. Treasury. So you can get your account established by filling out Form 4547. And if you have a child that was born in 2025 or now in 2026, there's a section you mark to get that extra $1,000.
So you're saying you're excited about this because it obviously, we very rarely go, hold it, the government's doing something that we feel like is going to, why did these 529 enhancements or free money, as you say, in the Trump enhancements make a difference for our families now?
Yeah, so I think this is the cool thing, I think. You know, I've heard a lot of talk about from families that if they don't have, because you can actually have a Trump account for any minor between the age of 0 and 18. They all don't qualify for that extra $1,000. But I actually think it still makes sense in a lot of households to open up the account, because what you're doing, now let me contrast 529 to the Trump account.
Please do.
So the 529 should be used for educational purposes. So that would be your goal in mind, that I'm going to open up this 529 so that my child or grandchild can use these funds to pay for their educational expenses. The Trump account, you would look at that totally different. The Trump account is intended to build long-term wealth.
Yeah.
And I just think that's really cool to have the opportunity to do something like that for my grandchildren, to get some accounts open for them at a very young age, with the idea being that this is not really intended to be for something they use as an 18-year-old or a 25-year-old. I'm seeding a retirement account for them that's going to provide long-term wealth.
I mean, isn't that the idea when we're talking about this, is creating a discipline? And we fail to start when we should be starting on a lot of these things. This is one of those to say, for a lot of families to say, I don't have the money to be, I just had a kid. Do you know what it costs to have a kid? I'm putting this in. This is now creating an American discipline to say, yes, let's start the right way.
Yeah, it's for one, I just piggybacking off what you said, I can't tell you how many people that we have met with that come through the doors and they say these words, I wish I would have started earlier. So this is creating the opportunity to start earlier for these young children.
Okay.
And let me put some numbers to this, because this is where it gets crazy, right? So you can contribute up to $5,000 per year of your own money. Now, obviously, a one-year-old child is not going to have their own money, so that money would come from a parent or a grandparent or whatever. So if we qualify for $1,000 of the government money, and then we add $5,000, if we just did that one time for a newborn child, and we let that money then sit there until they were a retirement age, the numbers are crazy. So that one $6,000 contribution, a $5,000 of my own money, $1,000 of the government, by the time that child is 18 years old at a 7% rate of return, and let me clarify, there's no such thing as a guaranteed 7% rate of return. I believe that's a pretty realistic return expectation. Okay. So when that child reaches 18, that account would be a little bit more than $21,000 at that point. That's a decent chunk of money. That's exciting, but that's not crazy exciting. If they leave it alone, and this is how I would be instructing my family, do not touch these accounts. I put the money in, I seeded it for you, you leave it alone until you get to retirement age. And let's just say that's age 65. That one $6,000 start turns into $521,000.
Goodness gracious.
With just that modest start. So how many families out there would love to set their kids or their grandkids up for a success by getting something started, teaching them how to invest, letting them watch how these accounts grow over time, which would motivate and inspire them to do it themselves? What a great head start, though.
Is there anything greater than compounding interest as you start to work on this?
It's a miraculous thing.
It is. And look, it's a miracle that's now been put in place. If we're talking miraculous is really just discipline. To say, let's do this so that what if and when. And if you can get started using the rules that you've been given, why wouldn't you take advantage? If you need some help on understanding, because the experts are there at Citizen Advisory Group. Why wouldn't you use them? 866-630-1675. You can scan the QR code to set up an appointment so that we could put together a retirement checkpoint review. Do you know about all the changes? Do you know that the rules are going to continue to move? So work with the people who know the rules and the changes. 866-630-1675. Oh, we got more changes. Stay with us. Back after this.
My name is Kevin Bucher. I am co-founder of Citizen Advisory Group. So I became a financial advisor through kind of just working people with through their health insurance initially. So I was helping people specifically with Medicare. That evolved into more comprehensive planning around different areas of financial planning to include their investments, their retirement income strategy, taxes, the insurance where I started, as well as some estate planning. I think what inspired me and really a lot of the individuals here at Citizen Advisory Group is just a strong passion and desire for helping people. So we recognized that the financial services world was not doing a great job of meeting the everyday daily needs of a population, where they're not really providing specific individual solutions that are tailored to the individual. They're more meant to be services that work across a bigger subset of individuals. So what we do different is to try to just putting together solutions to the challenges that they face on a day-to-day basis to improve their outcomes in regards to their finances is very rewarding and still keeps me going to this day.
Welcome back to Retire Well. Brad Johansen, Kevin Bucher, Citizen Advisory Group. We're kind of talking about changes. We started with changes to minors, how that's going to affect families. Let's shift gears, Kev. When we talk about, I guess this is the retirement income squeeze, I should say. RMDs, for those of you who don't know, required minimum distributions, and there may be some of you actually approaching RMDs where you go, I still don't know what you're talking about. There are changes to required minimum distributions. The government likes to change required minimum distributions all the time. Take me into this.
Yeah, so on the surface, this is actually a positive change. But it has to be used. If we don't take advantage of this change, it becomes not a very beneficial change. Yeah. So it wasn't too long ago that the required minimum distribution age was 70 and a half. Mm-hmm. It then was raised to 72, and then they raised it to 73.
So they're stopping there, right?
No, because it's on its way to 75.
Oh, goodness.
Right? So for today's retirees, though, it's basically 73. For the next generation of retirees, it's already been made clear that it's age 75. So that's a good thing, because that means we have more time to play the game by our own rules as opposed to playing by the government's rules when it comes to our pre-tax retirement accounts or our tax-deferred accounts.
Yeah.
And as you know, the bulk of the dollars of U.S. savings are in these qualified retirement accounts, whether it's IRAs or 401ks. So when we get to the age of 73, there's mandatory withdrawals. The government sets the rules for how we have to use these accounts.
Yeah, it's not really required minimum distributions. It's we want our taxes kind of thing.
100%. That's what it's all about.
Yeah, okay. Beneficiary changes. Anything there that we need to pay attention to?
I think a huge change was made here. So it used to be when we inherited an IRA account or a 401k account, we would have the option to stretch the distributions from that account over the course of our lifetime. So we had many, many years to deal with the taxes. So a lot of people are still confused about the fact that when we inherit an IRA or a 401k, those dollars haven't been taxed yet. Just because the person that set that account up is no longer with us, the taxes are still due on that account. Yeah. So it used to be, I used to be able to take that as a beneficiary, and I would be able to stretch the withdrawals out over many, many years. Well, they've now squeezed that to where we have to take full distribution by the 10th year. So if you put those two things together, that's what we're calling the big squeeze. They raise the age that we have to start taking our withdrawals. At the same time, they shorten the duration that our beneficiaries have. So these accounts, we're going to deal with the taxes on these accounts in a much tighter window. So when we have a tighter window to deal with the taxes, that means bigger distributions are coming out on an annual basis. Bigger distributions could lead to what?
More taxes.
More taxes for the IRS.
Okay, so I want to put this up on the screen for you guys. It is mytaxbilltest.com. We've used this in many other shows. How much have you put away? Well, you've been told to put it away, tax deferred, you're qualified for more taxes. This calculator will give you an idea of what Uncle Sam wants now at RMD age, if you want to pass it on to the next generation, and some of the strategies that you want to use. Scan this QR code while we have this on the screen, so that it's very user-friendly. It takes you a couple minutes. I apologize, you can't unsee the numbers once they're there, because it is shocking that you weren't told by another advisor that this is what you have coming forward. So give me impact examples tax-wise of what we're dealing with and stuff like this.
Yeah, here's the thing that I think stands out, the shock you are going to see when you look at these numbers, is that you have X amount of dollars today that you're going to pay taxes on when you distribute them.
Yep.
But this calculator is going to take into account that, well, these dollars are hopefully still earning and growing for you.
We want to grow.
And every dollar that you still are earning inside of those accounts is a shared dollar of earnings with the IRS. So if you're in the 32% tax bracket, for example, every dollar you make is going to be shared at 32% federally, and plus you got the state taxes. So what can you do about it? Well, what you can do about it is not just continue to kick the can down the road. We have to have a proactive approach to dealing with these taxes, and that's where things like Roth conversions come into play. So how do I take this tax-deferred account and start repositioning that strategically, knowing where the tax thresholds are, strategically taking money from tax-deferred status into tax-free status, so that I'm the one setting the rules on how much tax I'm going to pay, not just kicking the can down and playing the government's game, which is what the tax calculator is going to show.
Okay, you say on my rules. The nice thing about it is that Tax Cuts and Jobs Act was supposed to end in 2025. Now we've had an extension. Whoop-de-doo, you may say. Yeah, it is a big whoop-de-doo. If you're dealing with Roth conversions, we talk about runway all the time. If you've been given another at least 3 years now, 4 years in total, to make these conversions while you know what the rules are, tell people where we are tax-wise, because nobody feels like we're in a good spot.
Yeah, nobody likes to pay taxes at all. But historically, we're in a pretty positive rate environment. If you look at even just the amount of income we're allowed to deduct away with the increases to the standard deduction, and now for folks that are 65 and above, they're getting an extra $6,000 deduction through the enhanced senior deduction.
Yeah.
So a significant amount of our income's not even counting towards income taxes. And you kind of hit the nail on the head that if I retire prior to the RMD age of 73, that generally is going to be the sweet spot for when I can be proactive and start dealing with the taxes. Because as a worker, I was likely earning a higher income,
sure,
higher tax bracket. Then I go into retirement. Well, Social Security is tax advantaged. I got all those deductions. So we typically see that people fall into a lower tax bracket. Well, we want to take advantage of that prior to the required minimum distributions kicking in, because oftentimes we see that kicks you up into the higher tax bracket again. So we have a high tax bracket while we're working, we have a high tax bracket when the RMDs kick in, and we have this valley from retirement to the RMD age. We can't just sit back and enjoy that. We got to take advantage of that, and that's how we beat the government at the tax game.
You talk about other strategies beyond this, like qualified charitable distributions?
Huge option. Once you're 70 and a half, if you're doing any charitable giving, you should be taking advantage of pulling money out of the IRA directly to the charity. Doesn't show up as income, so that means it's tax-free. There's a tax-free way to make those charitable contributions. Got to be 70 and a half.
You list life insurance as a strategy. Why?
Well, a properly structured life insurance policy, we can access the cash values of that in a tax-free way. But I would caution people that policy has to be structured properly and used properly. Otherwise, it can turn into the exact opposite of a tax-free distribution and be a tax bomb.
It's complicated to the point of understanding when the rules are in your advantage and when they're going to change to make it more of a disadvantage for you. MyTaxBillTest.com will give you an idea of where you stand right now. And right now, there are strategies. You will see that on your page as you scan this QR code to find out what strategies might be more advantageous for me. Then you're going to want to make a call to 866-630-1675. Let's put together a retirement checkpoint review for you. And I'm getting close, or I'm right there, or maybe I'm already in this and I didn't know a lot of this stuff. Do you want a retirement checkpoint review? I mean, why wouldn't you? It's complimentary. It is for your benefit when the rules are constantly changing. 866-630-1675. We're back with more after this.
As a youth, I spent my summer months on the construction sites with my family. I think I learned early on the value of hard work. Ultimately, though, I was led into the financial services world where I joined my brother Jeff.
You know, I think many people think that the financial piece is just so prevalent and the most important component, but there's just more to it than that. It's about the experiences, it's about the relationships, it's about the life that our clients are living.
They've got things set up so that the biggest decisions I have to make are whether to use a 9-iron or a pitching wedge, and what is my cocktail this evening.
It's our family coming together with your family. It's your financial pieces coming together to have a coordinated plan. It's our community coming together to keep that social connection.
I like the family atmosphere that they have. I think they treat everybody like they're part of the family of Citizen Advisory Group. I just love that they take care of us.
I think we pride ourselves on the comprehensive services that we offer, which starts with the holistic financial planning.
That retirement checkpoint view is going to be a full review across the areas of investments, your income, taxes, insurance, and your legacy and estate plan to make sure that you have a coordinated plan and it is tailored to you, the individual.
We build all of this together to get the most out of your retirement so that you can have the retirement that you've always dreamt of.
Glad you're with us. Retire Well. Brad Johansen, Kevin Bucher, Citizen Advisory Group. We're talking about some of the financial planning changes that you need to be aware of. And it's a lot. We did minors. We're talking about taxes and Roth conversions and what we do. We have to hit medical. So Affordable Care Act. Are there changes within that now that we need to pay attention to?
Yeah, I mean, this got a lot of publicity towards the end of 2025 as the subsidies were set to expire. So, you know, it's a big deal for a lot of individuals, especially those that are looking to retire pre-Medicare eligibility, right? So you're first eligible for Medicare at the age of 65. And if you're gonna look to retire at 60, 61, 62, or whatever that age is, any age before 65, you're likely going to lose the employer-sponsored health coverage and go on to an Affordable Care Act plan. And obviously, as we get older, having the right health insurance plan is really important. But this issue has become about more than just the right health insurance. It's about income and controlling your income, because it quickly becomes unaffordable, the health insurance, when we start to lose these subsidies.
So do we need to pay attention to what the changes are? You say American Rescue Plan has changed. How so?
So the American Rescue Plan that was passed into law actually changed the qualifications for subsidies. So prior to that bill being passed, as your income went up, you would lose the ability to get government assistance for the health insurance, which, you know, I think that maybe makes sense, right? So at a certain income level, you became ineligible to receive any subsidy dollars to go against the cost of your health insurance premium. What the American Rescue Plan did is it eliminated that cutoff and extended the subsidy. So as your income continued to go up, you would continue to qualify for some subsidy assistance. Now that was never intended to be permanent. That's why it had a sunset date.
Yeah.
It was extended by the Inflation Reduction Act, but in 2025, that was when the deadline ended, and it was not renewed. So what we saw was people that were getting pretty significant subsidies to help cover the cost of their health insurance premiums. Those subsidies now ended because their incomes were too high. and health insurance quickly became very unaffordable for a lot of people.
Why does all of this matter? And I know the significance in retirement is that Medicare costs aren't going down. We have to pay attention to where we are, and once we hit 65, what the ridiculous numbers are of the amount of people who are going to require long-term care and continued care. Why do we have to pay attention to the changes in this, let alone to the changes in Medicare as we hit that 65 age?
Yeah, because these things are so interconnected. So a decision you might make regarding a Roth conversion, or a decision you might make in selling an investment and taking a large capital gain, or maybe selling a rental property that had a gain associated with it. All of that has a tax impact, but it also could have an impact to your health insurance premiums. So I kind of look at it as there's a lead domino that happened, whether it was a withdrawal I took from my IRA account or a Roth IRA conversion, and we think we know what the impact of that is doing, but it actually caused something to happen over here that we didn't expect to happen. And that is why planning is so important. I had the privilege of doing a review with some clients I've worked with for a few years now. They are young, going to be young retirees. But that was always the plan from the beginning. So that plan always was about how are we going to get income, especially in the early years before we're eligible to even draw out of the IRAs and 401ks. What are we going to do for health insurance when we no longer are getting it from the employer? What's going to be the tax liability we face? So we already had looked at all of these things and were able to put together a plan. And one of the interesting things, we just did this review, and just a kind of the sticker shock of the Affordable Care Act. When we had their income at $84,000 a year, their health insurance plan was about $300 a month. But when it moved to $86,000, it quickly jumped to $1,800 a month. $1,500 jump. Now you might think, well, there's nothing they can do about it. That's not true. Proper planning allows us to control what their income looks like, be more tax efficient, get them what they need, and control these health insurance costs.
It's all a part of the plan. And do you have one? Are you staying current with all the changes? 866-630-1675. The experts there are. Scan the QR code, make the call, come into the office. Let's put together a retirement checkpoint review, just so you're up to date. It's always part of the plan. Get your plan now. We'll see you in the office, right back here next time on Retire Well.